So I just want first to take you through the course outline, what you're going to cover in this class. And you can interrupt me anytime and ask any question. Just type the question, I'll be able to see it, then I'll be able to respond to you, right? So this is our course outline. We're going to start with the key terminologies in Forex market. You'll notice when at times we use terminologies, and it's good to understand what each terminology means for you to be able to follow any kind of analysis or anything read about Forex. When you see those terminologies, you need to understand what they mean, what they stand for your ease of interpretation. Then after you do that, you go to overview of the Forex market, basically just an introduction to know what it's all about when you talk about Forex market. Then we go deeper into technical analysis and patterns. This is what is very key in Forex learning, because you need to know how to do your analysis, because if you don't get your analysis right, then you won't be able to enter profitable trades. So this will be very key. We have to learn about what analysts use to make decisions. You need to analyze to be able to tell when do I buy, when do I sell. Then we use what we call the candlestick analysis, which forms some patterns. We call them the trend lines, channels. Basically all these under technical analysis. Then we have the fundamental analysis, where now we rely mostly on the data or reports from the various countries of the currencies which we trade in. So fundamental analysis focuses mostly economic data and other geopolitical factors which affect the Forex market. Then we look at currency commodity correlations. There are some commodities which affect how a currency behaves. Like today, if you check the CAD, the Canadian dollar has been rallying so much because of the good price of the oil. Like oil is related to Canadian dollar, so you're able to know which commodities affect which currency. So when there's shortage of oil, we know the Canadian dollar is going to go higher and vice versa. We need to check on that. Then you go to trading psychology and risk management. And I always say this is very key. When you get here, you have to take it very seriously. In trading, we focus, risk management is number one, then profitability is number two. Because if you focus on profitability alone, it means you can make all the profit, then you lose all of it through poor risk management. So you have to cover how do you manage our risk while we are doing trading. Then our final topic is what we call copy trading. How to analyze the successful traders to copy their trades. All right, so we'll do a class on that. So right now, let's go to the terminologies. As I said, feel free to interrupt me, ask any question. I'll be able to answer that. The word Forex is short form for foreign exchange. That is, trading consists of buying and selling of world currencies. I'm sure right now in Kenya, if you go to the banks, you'll find they have some either electronically displayed exchange rates, how Kenya shillings is exchanging with the other foreign currencies, or a piece of sheet, a printout they give to the customers to show you. If you want to buy a dollar, how much are you going to spend in Kenya shillings? So Forex, it's always happening all world over, either directly or indirectly, all right? So we see it is actually the buying and selling of world currencies, and its marketplace is among the most liquid in the world. We say liquid because you can convert. Once you buy a certain pair, in Forex you can always dispose it of any time. You don't have to wait for a buyer to come, hours or days to come. You can actually buy a pair right now, and in 5 seconds, you liquidate or you dispose it of. It's extremely liquid because there are so many players, and there's also a lot of money which is exchanged, all right? So it's the biggest market and the most liquid in the world. I'm sure if you remember our commerce class or accounting class, we used to classify like liquid assets and the others. And we used to say the liquid assets are those can be easily converted into cash. And Forex market is one of the most liquid. The commodities we deal, which are the other currencies, can easily be converted to whichever other currency you want. They're the most liquid. And the unique aspect of trading Forex is that individual investors like me and you and speculators can compete with large hedge funds and banks. Here there is no, they cannot say, we cannot participate as long as we have what it takes. That's why we need to learn how do we analyze to ensure we are going with the masses, because we need to try to as much as possible to go with the masses, right? So that's why you actually do the analysis to be sure if the banks are buying, you buy. If the banks are selling, you sell, right? Because any one of us can participate. The market has been enabled to allow small traders like me and you to participate. Then you talk of currency pairs. In Forex, it's always traded in pairs, all right? If you say you're buying dollar, if you're buying dollar, you must be selling another currency. So it's always in pairs. You cannot just deal with one currency alone, but it's always dealt in pairs, all right? So think of money as a commodity. So you are buying a currency, hoping that its value will increase. And if you're selling, you're betting that it will decrease. Remember, in Forex, it's the only market you can make money both ways. You can make money by buying, you can make money by selling, all right? So it's both ways. If the currency is increasing in value, you buy hoping it's going to go up, then you sell at a higher price. If the currency is coming down, it's losing value, then you sell it, waiting for it to come down. Once it goes down in value, you liquidate your trade, all right? So in Forex, you make money both ways. Currency increasing in value, you buy. Decreasing in value, you sell. Like today, the Euro USD really dropped because the dollar is strengthening and the euro is weakening. So what is happening? People actually selling the euro and buying the dollar. Yeah, so it's always done in pairs. So if you say your dollar is strengthening, you have to say it is strengthening in comparison to which other currency. So you try to pair the one which is strengthening, getting stronger, versus the one which is weakening for you to get a good currency move. So it is always done in pairs. And you're safer when you pair two currencies where their strength and the weakening, there's a big differential in their strengthening and the weakening. So if the one is weaker, it's getting weaker, and then one is getting stronger, you pair the two, and then you enter your trade, whether you're selling or you're buying, and you're going to see how do you do all that, all right? Then we go to quoted currency and base currency. Remember, we said they are always in pairs, all right? So in Forex, currencies are quoted in pairs. We have a case of USD-EUR. Is that US dollar versus euro? So using this quotation, the value of a currency is determined by its comparison to another currency. Just what we said under the pairs, all right? So the first currency of a currency pair is called the base currency. Like when you look at the USD-EUR, USD is our base currency. Then euro becomes what we call the quoted currency. So the first currency of a currency pair is the base currency, and the second currency is called the quote currency. The currency pair shows how much of the quote currency is needed to purchase 1 unit of the base currency. Like the example we've used here of USD-EUR. USD is our base currency and the euro is our quoted currency. So we are saying, there'd be like 1 unit, you need this amount of euros to get 1 unit of the USD, which is our base currency. So it is priced based on the base currency. So we're talking the 1 unit of the base currency versus a number of units of the quoted currency. Yeah, so they're always quoted in pairs. The first one before the slash is the base currency. So we always talk about the 1 unit of the base currency compared to a number of units. Remember, those number of units can be 0.00 something or 1 point something or 80 something, but we are referring to 1 unit of the base currency compared to this number of units of the quoted currency. So the first pair before the slash is our base currency. The second pair is our quoted currency. Then we talk about the bid and ask price. Like when you are buying a stock in the stock market, when trading currency pairs, the Forex quote will have a bid price and ask price. Yeah, so the bid and ask prices are always quoted in relation to the base currency. So remember, everything is in relation to the base currency because we're talking of the 1 unit of the base currency versus number of units of the quoted currency. So when selling the base currency, like when you're selling the USD versus Euro, we are selling actually the base. When you say you're buying this pair, you're actually buying the base currency. When you say you're selling this pair, you're selling the base currency. And you're doing the opposite to the quoted currency, right? Like when you're selling the base currency, the bid price is the price that the dealer is willing to pay to buy the base currency from you. You're saying it's the price you will receive if you sell, all right? Remember, I will still give some example like giving like in an auction. Auction, we say the highest bidder takes the property. So you can use that kind of, understanding to know what the bid price is. So if I'm selling, I'm selling USD. So the bid price is the person, the other person who is buying from me is willing to give me to take the base currency. So the bid price is the selling price. So when I'm selling the currency, the bid price is the price the dealer is willing to pay to buy the base currency. Remember, it may sound complicated, but as we go deeper, it just comes automatically, no much, thinking required. It just comes to understanding when you read bid price and ask price. When you're entering your trade, how do you interpret the prices you see on the dialog box or on the chart? So you are saying bid currency is the bid price is the price you will receive if you sell. And when you're buying the base currency, the ask price is the price at which the dealer is willing to sell you to the base currency in exchange for the quote currency. So simply put, we say when you want to buy a base currency, the ask price is the price you're going to pay. So why we need to learn this is when you're selling, before you click the sell, your trade will be filled at bid price because it always displays for you bid and ask price. Just for you to understand, when you're clicking that sell entry to sell your pair, your trade will be filled at bid price. If you're buying, before you click the buy button, your trade will be filled at ask price. And again, we said no big deal. We'll only see somewhere where this really makes so much sense when especially it makes more sense when you're selecting a broker, right? But when you're already in it, there's nothing much you can do because it's already displayed. You cannot change it, just for your own understanding. And you're seeing a typical currency quote can be seen below, like USD CAD. So we can get that pair. USD is our base currency, CAD is our quoted currency, and then we get a quote of 1.2000/05. So the first price before the slash is the bid price, right? So if I was to sell this pair, it means I'll be filled at 1.2000. Then the second price after the slash, which is 1.2005, is the asking price, which you're saying, this is what I want to buy this. So the other person, the dealer, is asking for this one. Again, I like to use the analogy of, let's say you go to the market, you want to buy a goat. You are the one buying the goat. So the owner of the goat is asking, I'm asking for this amount of money for me to give you my goat, right? So just the same kind of scenario of any other market. Is the same kind of language in the Forex market. There is no much complication about the pricing. Then we go to pips. In Forex, we count our profitability or our losses by the number of pips the pair has moved once you entered your trade, right? So pips or a point is the common name used to refer to incremental changes in a Forex quote. So like using the example we used, like USD CAD of 1.2000, if the price moves from 1.2000 to 1.2001, we say it has moved by 1 pip. That move in the fourth decimal point is the pip, all right? So although this currency movement may seem small, due to leverage, we'll know what leverage is all about. Used in the Forex market, small changes can result in large profits or losses. So when we say I think some of you have been in one of my charts. You see, always say maybe this number of pips my trade has moved in. So the pips are translated now. It is 1 pip is equivalent to a certain amount of dollars, all right? So when your trade has moved certain number of pips in your favor or in profits, then you multiply that by the amount. Like most of them are plus or minus $10. A pip is plus or minus $10. Some are $12, others are $7. So if the pair you've purchased, let's say the pip is equivalent to $10, and after you entered your trade, it moved maybe to 10 pips in profit, then your real profit in cash will be 10 times 10, because it's 10 pips times $10 per pip. That gives you $100. That's how we calculate the pips. So many times you see, even if they're quoting and maybe you're reading analysis somewhere, they will never tell you to move in this number of dollars, but it's always quoted in pips. We say the Euro USD has moved this direction for 100 pips or 200 pips. So that's how we count profitability or our losses. Yeah, we count in pips, then we multiply by the amount of dollars per pip for that particular pair. Each pair has its own costs, or rather number of dollars per pip, which is plus or minus $10. Huh? Then we have the word spread, and you see the difference between the bid price and the ask prices in a Forex quote is normally called the spread. It is like the markup or the margin in a normal market setup. You know, if you buy a kilo of sugar today at 100 Kenya shillings, and then you want to sell it, you're selling at 120. You bought 100 shillings, you're selling at 120. That difference between your buying price and the selling price is 20 shillings. That is the spread. So that is the same logic in Forex. The difference between the bid price and the ask prices is what we call the spread. So like this case here in our previous quotation, USD CAD, bid price was 1.2000, asking price was 1.2005. So the spread is the difference. That is 1.2005 minus 1.2000, which is 5 pips, right? Because you say a pip is the incremental change on the 4th decimal point. So in this case, our 4th decimal point has changed from 0 to 5. So those are 5 pips, and that is the spread. The difference between the ask price and the bid price. Please, in case you get lost, you ask me any question. But as we said, it will get more clear as we go deeper into Forex. But it's good to have this understanding as we quote some of these terms to understand what we mean by that, all right? And the brokers make money through the spreads, and it's recommended when selecting a broker to consider the brokers with small spreads. So as I mentioned, the difference between the ask price and the bid, they only make more sense when you're selecting a broker. Otherwise, once you've already picked your broker you're comfortable with, then you can never really consider so much about that. Yes, so like the broker usually recommend FXTM. These guys have the best of the spreads. Like if you sell gold in Forex, it is XAU USD. That is XAU USD. If you sell that pair, spread is always 0 when it comes to FXTM. But I know some of the brokers, actually, they give XAU USD the biggest spread, some as big as 5 pips, 10 pips. As I mentioned to some of you, I've tried some of these many brokers, and I know when it comes to pricing, FXTM is one of the best. Like if you sell XAU USD, spread is 0. Of course, when you buy, it's a little bit different. So it depends on the transaction you're running. So the spread a broker assigned to these pairs can actually determine whether you're gonna make or lose money, because you can be so much profit, but much of the pips are going to the broker in form of a spread. It's very key to select the kind of broker you're investing with. But I tell you, FXTM is one of the best. Of all the ones I've tried, when it comes to pricing, FXTM is the best. Brokers also assign commissions. Yeah, you find there is spread plus commission. Same case, FXTM has one of the lowest commission. Of all the brokers I've used, most of the commissions are $7 per lot. But FXTM, most of them actually they are $5. Like XAU USD, gold usually mostly priced by most of the brokers, but it's cheapest with FXTM. Their commission for gold per lot is $5. Again, the cheapest. So you use all this when you select a broker to ensure you don't just work for the broker. You know, you can work so hard, you make your profit, but half of it goes to the broker, all right? So you're selecting a broker, you have to check on the spread. And as I mentioned to you, FXTM has one of the best spreads I have ever come across in the Forex market. So we want to check using that quotation. I want to analyze it and see what we can, how can we interpret that kind of a quotation? That is, this, we are given this pair is USD CAD and it's priced at 1.2000 stroke 1.2005. So how do we interpret that in detail? Just for us to understand the terms we've already covered. And I'll take us to the next page. So from that pair of USD CAD, the base currency is the USD. That is the currency to the left of the slash. The quoted currency, sorry, it is CAD, the currency to the right. Yeah. And you're saying the bid price, which is the price in when you're selling, the price at which you're trying to be filled at. Bid price is 1.2000, price for which the market maker will buy the base currency. So in this kind of a quotation, you're saying to, if you're, let's say you're selling, and when you're selling, you look at the bid price, because that is the price the other person, the dealer, is willing to buy that from you. So if the bid price is 1.2000, we are saying for you to sell 1 unit of USD, the base currency, we talk of 1 unit, you will need, the other person will give you 1.2 units of CAD. Because CAD is the quoted. So the base currency is always 1 unit of the base currency versus this number of units of the quoted currency. All right. Then we have the ask price is the 1.2005, and that's the price for which the market maker will sell the base currency. Because we want to buy now, it is the price a little bit higher. Okay. Then the PIP, and we said 1 point move in USD CAD is, that is the movement on the 4th decimal point. And if it moves from 2000 to 2001, then we see it has moved by 1 pip. That movement on the 4th decimal point. But for some pairs, it's always up to 2 decimal points, like the Japanese yen pairs, USD JPY, you know, CAD, all the Japanese, the JPY pairs, they are always up to 2nd decimal point. So that means the people for such kind of pairs is the movement on the 2nd decimal point, right? Again, they just come automatically. You don't have to really try to cram and it always be saying you don't need to decide which one you're going to give 4 decimal and which one you're giving 2 decimal. It's always automatic. Just for us to understand, when you see that, you don't ask how come these two are different. Right? So some have up to 4 decimal points, others to 2 decimal points. And mostly the JPY isn't that kind of pairs. So again, we see the spread is there. In this case, will be 5. That is the asking price minus the bid price, which gives us 5 pips. Then we go to what we call a lot. Yeah? So like we're saying, similar to how most stocks trade in lots to facilitate trading, currencies are also traded in lots. And I like using the example of Nairobi Stock Exchange. If I was to buy shares today, like Safaricom shares, they cannot sell to me just 1 share. We have the lot sizes. So if I was to buy shares from Nairobi Stock Exchange, what is the lot size? They are sold in what sizes? I'm waiting for one of you to reply to me that question. If I was to buy from Nairobi Stock, can I just buy 1 share or 2 shares? So how are they grouped? They are in what lot sizes? Very good. Thank you, Lydia. They're in 100 sizes. That's there, like 1 lot. So the same case with Forex. And why they group them, you can imagine if Safaricom was said like 1 share, 2 shares, yeah? It means everybody in Kenya, like 40 million of us, we can actually buy or just need to buy 2 shares, it's just like 22 shillings and all that. So to make it manageable for them, even in the accounting, the market has to adopt a certain number of groupings to make it manageable when it comes to sharing of dividends and all that. So the same scenario in Forex. It's also done in lots. And in Forex, 1 lot is equivalent to 100 $100,000. Remember, this market is quite huge. No one controls it. Anytime you can come in, anytime you leave, anytime. You don't have to really follow any kind of rules. It is a self-regulating market. Yeah. So it's also like it has to ensure it is very easy to manage by having some set sort of standards. So one standard lot is equivalent to $100,000. Yeah. But to enable some of us to participate, these have been broken further to smaller sizes, and we call them like mini lot and micro lot. All right. And a mini lot is equivalent to $10,000, and a micro lot is equivalent to $1,000. Just to ensure, to make it, manageable for smaller people, smaller traders, yeah, like some of us. So this may seem like large amounts, but because currencies only move in small increments, only a few pips at a time, so a large amount of currency is needed to generate any sizable profits or losses. Again, if this market was just to be traded like that, they said it minimum you can use is $1,000, it would still lock out most of us. Yeah, because if to get that amount of capital, and you cannot just trade with $1,000, it means you require a little bit more than the size of a lot. So still to enable us to be able to fit in the market, there's what we call leverage, which becomes our next point. And leverage is like a loan the broker gives you to enable you to trade. All right. If you saw in my earlier message on WhatsApp, we said select a leverage of 1:500. Like this broker FXTM, they give a leverage up to 1:1,000. Yeah. But again, we say leverage is like a double-edged sword. If you select something like 1:1,000, it means for every dollar you invest, they are giving you 1,000 times, right? So it makes it possible for you to trade bigger amounts of money, but it's also more risky because it means also if you go into a loss, you're also going to lose a lot. If you're going to profit, you're going to pocket a lot. But again, if you're going to losses, you're going to lose so much. So we say leverage is a double-edged sword. You have to be careful as you select it, all right? So I really recommend maximum 1:500. If you can select 1:200, better for you. It's part of managing your risks, right? So you see, leverage is the use of the other people's money to buy or sell contracts or securities. So if a broker offers 20:1 leverage, it means he is willing to allow the trader to borrow 20 times the amount of money in the account to make a trade. So the extreme amounts of leverage that are common in the Forex market occur because the Forex is the largest and most liquid market in the world, making it very easy to get into and out of a position. So this allows a trader to control with a certain certainty how much he or she is willing to lose on a trade. So I really recommend mostly maximum 1:500. Because when you see 1:1,000, although it gives you bigger exposure to trade, it also gives you a bigger exposure to risk. So you have to, this is part of risk management to ensure you only take leverage which you're able to manage without exposing your account so much. So it's like the kind amount of loan you get from the broker for you to be able to trade. Remember again, you cannot withdraw that money. You cannot say, no, I can still take away. No, there's a way they control that. You can only actually access your money, but they are, that leverage is always, it's only available when you trigger a trade. By just looking at your account, you cannot see like your account is, like, let's say you put $100. Don't expect to just wake up and see the balance is 100 times 500, which is 500,000. No, your account remains the balance you've put, but now the leverage is automatically triggered anytime you enter a trade. That's how you utilize it. You only utilize when you're in a position or when you've taken a trade. That's when you utilize leverage. Otherwise, your account balance remains just what you put, but anytime you enter a trade, the leverage automatically triggered and allows your account to utilize the loan, and then you enter your trade. Then we have what we call margin. Margin and leverage, they're more or less like the same. It's just buying on margin is borrowing money from a broker. But this comes in because remember you are trading using the broker's money. So the broker is exposed. So they put some controls to ensure there is, if you are going into a loss, there is maximum loss your account can take without exposing the broker, because they will not allow you to just enter into losses and utilizing the loan to their disadvantage. So they set up some percentages such that as your account goes into losses, the margin level continues reducing. Yeah, and this brings us to what we call the margin call and margin stop out. So like for this broker, if your margin percentage goes below 80%, you see a red line triggered at the bottom of the screen. You're not yet live, you may not have seen this. Yeah, but if your margin level goes to less than 80%, the broker gives you a signal, a red signal, tell you your account is in danger, you need to do something. Either you add some money or you close the loss-making trades, all right? So if they give you that signal and you do nothing about it, they wait until it's around, I think for FXTM, it has to go up to around 50%, then they close all your trades because already you're risking their money. So they ensure they set up the system in such a way this loan cannot work against them. All right. So they ensure their money is safe. You can only lose yours, but you cannot lose their money. All right. So that's why we have this margin call. Margin call is when you see that red light flash at the bottom of your screen, telling you, see, you're in danger zone. Do something. Either close some of the trades or add more capital. So if you do nothing now, they do the margin stop out. When you reach 50%, they automatically close all your trades. And then now you're closed out. So those are the controls there the brokers put in place to ensure they protect their money, the loan they have given you. Then we talk about the bulls, and in Forex, bulls are the buyers and are responsible for pushing the market up. I'm sure you've listened to Nairobi Stock Exchange, the business news in KTN, or whatever the local news, and you hear the bulls did this, the bears did this. So the bulls are the buyers, and the buyers push the market up, right? Just a second. So when there are more buyers, just like any other commodity in the market, if the demand is more than supply, what happens? The price goes up. So the same case, if you have more buyers, more bulls for that particular pair, the price goes up and the pair goes up and up and up. So if there are more sellers and the sellers are the bears, yeah, let's say we have more supply than demand, what happens? The price will go down. So the pair starts going down and down. So what you do in Forex, as you do your analysis, you try to join where there are the masses. If the bulls are in control, join the bulls. Don't do the opposite, because bulls are buying, they're going to push the market up, join and go up with them. All right, that's how you benefit. Because if you go against them, you're going to be knocked out. All right. So if the sellers are in control, we have more sellers than the buyers. The commodity is going to move down. They push the market down, all right, because the supply is higher than the demand. So the price of the pair is pushed down. So you try as much as possible to be with the side of the masses. If the bulls are in control, be with the bulls. If the sellers are in control, be on the side of the sellers. That's where you benefit. But if you go against it now, you get knocked out. It's like swimming against the sharks. You better swim in the same direction with the sharks. Then we have another term called market execution price. In Forex, there are many prices you can adopt, depending on your decisions. Which one are you comfortable with? If you're going to see the various types of the market prices, or the prices you can enter the market in. And one of them is market execution price. This is the price you see the moment you open your screen to enter a trade. The price displayed there is the market. If you just click sell or buy, it means you've entered at the current prevailing market price. So it means placing orders or entering trades at the bid or ask price displayed on your broker screen. The moment you open the prices you see there is the market price. So if you just click sell or buy, it means the price, the trade is entered at the price you can actually see on the screen. Then we have the pending orders. What happens? You can actually say, no, the market is here, but I feel the market is going to move to this direction. So you decide the price you are comfortable with, and you then now use the pending orders. Yeah, there can be a pending order to buy or a pending order to sell. So you're going to see the types of pending order, whether you're buying or you're selling. And one of them is a buy stop. And you say a buy stop order is an order to buy a security which is entered at a price above the current offering price. And it is triggered when the market price touches or goes through the buy stop. So what you're saying for a buy stop, let's say the market has been going down, but you see this market is going to reverse. It has been going down, but you want to buy. Remember, we only buy when it's going up. And so when it's going down, you can only sell, but you don't want to sell. As per your analysis, you feel this market is about to reverse. Yeah, it's going to reverse, start going up. Then I will join in and buy with the bulls. So you say, I will only be sure this market has reversed if the price comes up to this certain level. Then you set up your painting order. You tell the market, as you come up, fill my order, go up with me. All right, because you're saying at this price, it is triggered when the market price touches or goes through the buy stop. Yeah. So traders using a buy stop hope to gain if momentum gains on a particular stock. I will demonstrate this in a particular chart. Let me just explain and I'll show you an illustration of how these ones are used. Then we have the sell stop. Sell stop is the opposite of a buy stop. The price has been going up and up and up, but you don't want to buy. From your analysis, the market is getting exhausted. It's likely to reverse any time to come down. Remember, we only sell when the market is coming down. So you say this price currently the market is around here, but I feel it is coming down. But I'll only be sure the bears or the sellers are in control once the market reaches this particular price. All right. So you set your order. You set your stop, your sell stop, so that when the market comes and passes through your target price, it fills your order and goes down with you in profit. That's a sell stop. Then we have the buy limit. And the buy limit order is an order to purchase a security at or below specified price, allowing traders and investors to specify the price they are willing to pay for a security, such as stock or currency. For a buy limit, you watch the market, you see the market has been going down and down, but you say the market is like to exhaust at a certain level. The price has not yet, that price you picked has not yet been reached, but you're saying, from my analysis, I feel this price will go down to this particular, this will be the real bottom it can actually go. So I want the market, as it goes down, it will reach here, fill my order down there and come up with me. That's a buy limit. Then you have the sell limit, which is the opposite. The market has been going up and up, but you feel it's almost getting exhausted. And from your analysis, you feel the market will reach a certain level, certain price out there and start coming down. So you set up your sell order above the current price. You're selling the market as you go up there, fill my order and come down with me. Then let me just, before I go further, let me just do an illustration of how this works. Let me pick, sometimes using words alone may not make you see. Let me just use, oh sorry. No, not there. Hope you can see my screen. So let's use our pair. It was USD CAD. Sorry, sometimes using this one is never easy. We know our pair is USD CAD, yeah? So currently the price is here, and it is 1.2000. So that is our current, this is our market price. I'll call it MP to mean our market price. But from analysis, you see the market is going up. Currently it's going up. And you want to, for a sell limit, from your analysis, you see the market is going to come around here. This is the maximum level the market will come, right? This is the maximum. From your analysis, you feel the market will reach here and reverse, all right? Our maximum price. We call it 1.2200. So now, because you feel that is the maximum, possible the price is going to reach and come down, so you set up your sell limit. So at 1.2200, you set up your sell limit, the maximum price possible. All right, that's your sell limit. So you're telling the market, you go up. I know you're gonna reverse around here. As you reverse, fill my order and come down with me. Because we say when the market is coming down, you sell. So you want to be filled at the best price possible. And for a sell, the best price possible is the highest price possible. All right. If you sell when it's up there, then it's come down, you liquidate at a good price. So sell limit is the maximum price you feel the market will reach and come down with you. Okay, that is the sell limit. Then there's what we call the let me remove this. I illustrate the sell stop. So the sell stop, use the same scenario, all right? So we feel once the market reaches, the market is actually going up, but you don't want to buy because you feel it's almost getting exhausted. It might reverse anytime. So you feel the market is going to reverse around here, but you're saying I'll only be confident that the market has reversed and the sellers are in control if the market crosses this line, all right? You put a price a little bit lower than where you feel the maximum is, where the price is already around here, but you feel the price is actually about to reverse. So you're saying, I'll only be comfortable with selling, I'll only be sure, or rather, yeah, be more confident that the sellers are in control once the price crosses this line, all right? So here you set up your sell stop, your sell stop. Sell stop. Okay, so you feel the market has been going up, then you feel it's gonna reverse, it's getting exhausted, the bulls are losing, they're losing control, the sellers are coming in, but you're saying I'll only be sure the sellers are in control once the price crosses this line. So you set up your sell stop here such that as the market comes down, it fills your order. There are advantages and disadvantages of these two orders, like for a sell limit, which is up here. The advantages of a sell limit are that your order is filled at the best price possible. The market goes, fills your order and start coming down. So you like to make more profit. That's the advantage of a sell limit. But the disadvantage is that the market might come, fill your order, and doesn't reverse. It goes up and up and up, now making you incur losses. All right, that's the risk with a sell limit. You better be sure the market is likely to reverse. So you have to do your analysis and be sure the probability of the market reversing at this level it's above 70%. So I take the risk. All right, so the risk is the market may refuse to reverse, fill your sell stop, and then it continues going up. Then you incur losses. Yeah. Then we have the sell stop. The advantage of the sell stop is that when the market is coming down, from your analysis, you feel the sellers in control, so it's gonna be filled, and the losses, the chance of a bigger loss is lower than for a sell limit. But the risk is you have filled at not so good price, like the case of a sell limit. All right, so that's the difference between the two. Then the opposite, the buy stop and buy limit is just the opposite of that. The market is here and now it is going down. All right, and we said when you buy, you want to buy at the lowest price possible. Then it goes up, you make profit. So we'll have our buy limit somewhere at the very bottom. Yeah, this will be our buy limit. So you're saying from your analysis, you feel the market will come up to around here, and then it reverses. So you're saying as the market comes down, you come, fill my order, go up with me. All right. So you set up remember the buy limit you set before the price reaches, it will go down, fill your order, and go up with you. Then the other one is buy stop. Yeah, just like the sell stop. So buy stop will be somewhere here. And you're saying for buy stop, from your analysis, you put the market, although it is going down, it will reverse around here, but I will only be confident that the bulls are in control if it crosses this line. So you set up your buy stop here, such that as the market reverses up, it fills your order, your buy order, then it goes up with you. So the advantages and disadvantages of the buy stop and the buy limit, they are just the same as for sell stop and a sell limit. Buy limit, advantage, you feel that the best price possible, so you can make the best of the profit. Disadvantage, the market can actually fail to reverse. It fills your order, then it continues, goes down with you, then you make more losses. Because you are buying with the expectation that the market is going to move up and move up with you. So if your order is filled and the market does not move, reverse and move up, it continues now going down and down, then you incur more losses. Then the buy stop advantage, the market already reversed, so you're filled, although you are filled at a not so good price, but the chances of a bigger losses are lower than if you entered a buy limit. So that's how I wanted to illustrate those two. Those are not pending orders. You set them before the price reaches where you want to enter your trade, as opposed to market execution. Market execution, you just trigger your entry as per the price you can see on the chart. Yeah, it's not like a penny just to wait for some time. Great. We go back to our presentation. We continue. Then we have what we call long position. In Forex, when you buy, we say you've entered a long position. Sometimes you can actually read and hear someone, you can read analysis and hear somebody tell you, I'm long USD, Euro USD. When they say they are long, they have just bought that pair. Long position means you're holding a buy position. I've gone long this pair. It just means you've bought. The opposite is short position. Short position means you have sold that pair, so you're holding a sell. Yeah, it doesn't mean you're in short of the pair or anything. When you say I'm holding a short position, it means you sold that pair. That's what it means. Then we have stop loss. In Forex, once you do your analysis, you can actually decide. You make a decision, you say, I feel now it is the right time to buy this pair. But remember, there is nothing guaranteed in Forex. The pair can always move in a different direction. So you're saying, although my analysis tells me the probability of this market moving up, it is over 70%. But just in case it moves against me and it moves downwards instead of upwards, you set up a limit of this is the maximum loss I'm willing to take. It can be 10 pips, it can be 20 pips, depending on your account size and depending on your analysis. So in Forex, you're able to set up the maximum loss you're willing to take for your trade, right? Whether it's a buy or a sell position. So a stop loss, it enables you to limit your losses. You're saying the maximum I want to take is $20 loss. With that, I'm confident. And the good thing, once you set up your stop loss, it gives you some, you don't have emotions as you trade. You know your trade is controlled, you let it run, all right, without putting so much emotions in control, all right? So stop loss it enables you to do emotionless trading. Place your trade, set up your stop loss, and you relax. You're ready for the $20 loss, you let it run. Yeah, if by any case it moves against you, you're only willing to take that amount of loss and you're comfortable with that. Because again, we say in Forex, there is nothing guaranteed. Because there is no one who controls the market. Anything can happen and things just move in opposite direction. You ensure you limit your loss. And I usually always ensure you make use of stop loss. I know many traders who don't use stop loss, but it's okay. They know how to counter their trades, not to make losses. But as a new trader, always ensure you use a stop loss. And remember, we don't just place the stop loss. You don't just decide like 10 pips or 20 pips loss. From your analysis, we decide based on my analysis. I feel when the price moves against me, should not go past this level. All right. So it is based on our analysis. We decide where we're going to place our stop loss, and you're going to see what we use to decide where you're going to place your stop loss. So based on your analysis, if you feel this stop loss is so far away, it's going to make you make more losses, you better not enter that trade. You're better missing out a trade than just entering a stop loss arbitrarily without any proper technical analysis. You must have an explanation and a logical explanation why you placed your stop loss where you placed it. Not just arbitrarily, I can only take 10 pips or 20 pips. Do your analysis. If your analysis allows, if your account balance allows you to place your stop loss for that number of pips of a loss, then do it. If you feel it's too big of a loss, don't take the trade, let it pass. But you're going to see all this as we go deeper into analysis. Then we have what we call the trailing stop. Once you've entered your trade and it's already in profit, you can set up the system. First, you move your stop loss to lock in your profit, such that in case the trade moves against you, that is the much you can actually lose. All right, that's the importance of a stop loss. So you can, once the trade moves into profit, you can convert your stop loss to what we call trailing stop. It trails the price. All right. So if you set your stop loss at, let's say, 20 pips, it means it keeps an equidistance from the market price of 20 pips. If the price market moves forward, your stop loss follows the market, locking in more profit. All right. And then if the market starts moving down, it just stops and waits for the market to come down. So this enables to ensure you lock in as much profit as possible. But a trailing stop only works if your system is online. You cannot leave it open until you go to sleep and then you expect it to trail. It just goes off. It becomes a stop loss and stops at one point permanently. But if your system is on, the stop loss, it trails the market and ensure you are locking in more profit, such that if the market reverses, you don't give back so much of your profit you've already made. All right. So that's the importance of a trailing stop. And you can only convert a stop loss to a trailing stop when you're in profit, not when you're in losses. Now you set up like it can be equidistant to the market price at maybe 20 pips or 10 pips. That one you just decide the way you're comfortable with. Then you set it up. So when the market moves forward, your stop loss, it follows it to ensure it is locking in more profit for you. So that if the market reverses, you don't give back so much of the profit you've already earned. Then we go to take profit. The same case like stop loss. We said stop loss enables you to limit the loss you can actually take. Take profit, it's a target you set. You say, based on my analysis, I feel the market will go up to this level and maybe start reversing. So you set the profit target. So when the market reaches this level, close my trades at a profit. Again, also, this is not just arbitrarily picked. It is based on your analysis. And we are going to see how do you set up your take profit. You just set the system, it just runs automatically. You enter your trade, set your stop loss, set your take profit, and you go on in your business. All right. So if the market goes into your favor, it will hit the take profit and close your trade at a profit. If it goes against you, if it go and hit the stop loss and close your trade data, the loss you already predetermined you're willing to take. All right, so you can just let the system run automatically without any interference. Then you go to what we call the dovish. What happens? Some of the things which make the market move a lot, it is the speeches from the central bankers of the major currencies. And as we go down, you're going to see there are 8 major currencies we focus on. So when some of those central bank presidents or governors or what their positions are, when they are making a speech, the currency for that particular country, like let's talk about US. US, we have the Federal Reserve Bank. If the chairperson or one of the governors is making a speech, the USD is going to react in a way depending on their speech, all right? So their speech can make the dollar stronger or weaker, all right? So, and many times what happens, currencies react to things like inflation reports and interest rates. Let me use that case for Kenya. Currently, we have what we call the CBK rate, which I think every month they determine, they communicate with the banks, our CBK rate, all right? So every bank has its own rate like that. And anytime that rate is increased, that currency becomes, the demand for the currency goes up, all right? Still later on, I'll tell you the stories about all this, but I'm using all this to explain to you what dovish means at the end of the day. So if that interest rate goes up for that, like the case of a central bank of Kenya, if the CBK rate goes up, if Kenya shillings was participating in the Forex market, every time the rate goes up, KS becomes of high demand, so it strengthens, right? So if the central bankers of the major currencies, if they are making a speech and they talk in a way like they are going to lower the interest rates, right? If the rates are lowered, that works against, it does not favor, it works against the currency itself. So it is likely to go down. So if their speech is in such a way that they are likely to lower the interest rates or have more quantitative easing. Quantitative easing is something like the treasury bills of Kenya and the treasury bonds. All right. So if the speak is like they're going to lower interest rates or pull more money using the treasury bills and all that, then that kind of a talk, which talks towards the aim of lowering interest, that's a dovish tone. And why you need to know this, we read some analysis here, the tone for that chairman was dovish. So that means the dollar is likely to go down if it's about the USD, right? So if they talk or the speeches, the tone is in such a manner that the investors interpret to mean they are going to lower the interest rates, their central bank interest, then now that is a dovish tone. So the opposite is the hawkish tone. If the central banker speech is in support of raising interest rates, maybe to fight inflation or reduce quantitative easing, then it strengthens that currency. All right. So that's the issue about the dovish tone and the hawkish tone. You'll see that so much as you get deeper into Forex when they are giving their speech. And every time you check the economic calendar, you always find scheduled speeches. It's not just impromptu speech. They always scheduled in the economic calendar. You can actually tell who is like to speech when, and you can know whether it's an important speech or it's a speech you don't need to pay attention to. Then we have volatility. You see, volatility refers to the amount of uncertainty or risk involved with the size of changes in a currency exchange rate. A higher volatility means that an exchange rate can potentially be spread out over a larger range of values. So currency volatility, also known as foreign exchange or FX volatility, is the unpredictable movement of exchange rates in the global foreign exchange. Basically, volatility means there are times of lower volatility. When there is so much movement in the currency, in a certain currency, we say they are more volatile, all right? Of course, there's a risk in that. But when there is no volatility in the market, then it means there's not many people participating. So higher volatility works in our favor because it means there are so many people participating. So you can buy anytime and liquidate anytime. Actually, it's the volatility which makes Forex market make sense. Although it is still the volatility which brings the risk in the Forex market. But a low volatile market, it becomes difficult to trade. You find there is no direction, you don't know how the market is moving. But if there is more volatility, more movement, then now you can actually enter your trade, and in 30 minutes in profit, you close your trade. Yes, so it's very important to have it in the market, although it also brings in the risk because of those uncertain movements. Then we go to liquidity. Hope you are together, you guys. You are not asking any question. Hope you're following. Okay. Hope you're quiet because you're following. Then we talk about liquidity. And as I mentioned earlier, we say the degree of an asset's ability to be converted to cash at its fair market price. So for an asset, this liquidity is its ability to be bought or sold without any discount or premium. Liquidity thus reflects the amount and frequency the asset can. Okay, in short terms, we said Forex market, they're most liquid because you can convert that pair into cash anytime. There's always somebody willing to buy, always somebody willing to sell. So you can buy now, after 2 minutes, you sell, right? Because there's always the most liquid because it has so many players and also it has big amounts of money exchanged. Currently, it's more than $5 trillion in a day. So it's the most liquid market in the world. Then you talk about technical analysis. This is where we use the price chart to do our analysis. Okay, so technical analysis is a trading tool employed to evaluate securities and attempt to forecast their future movement by analyzing statistics gathered from the trading activity. Basically, for technical analysis, you use the price chart, and then you're able to read some certain patterns which help you to predict where the market is moving next. Because our buying and selling is based on what do you expect the market to do next. You expect the market to move up, you buy. From your analysis, you expect the market to move down, you sell. All right. So technical analysis where we use the price chart to do our analysis and we predict where the market is moving next. So we enter our trade based on our expectations or our prediction. All right. And you're going to go deeper and see how do we do this technical analysis to tell where the market is moving next. Then we have fundamental analysis. This is where we use like economic data, inflation, employment, unemployment, and other geopolitical factors to determine where the currency is moving next. Like where we have like elections in US, we expect the dollar to move in certain direction, depending on what the investors feel, the incoming president or whoever, to treat the market as, okay? Also economic data. If there is high inflation, we expect that country to raise interest rates, so it makes that currency to be more attractive. All right. So fundamental analysis, we use mostly economic data and other geopolitical factors to predict where the currency is moving next. All right. But many times these two move hand in hand. You cannot say you're going to permanently rely on technical analysis or fundamental analysis. They speak to each other. All right. So, but it's good to know what each stands for or it means. Huh? Then we have what we call support and resistance. So this is common jargon for areas on the chart where price has difficult time breaking through. Support levels tend to stop price from falling below a specific point, and resistance levels act like a price ceiling that price cannot break above. We are going to use support and resistance mostly in our analysis, right? So because you see the market is always moving up and down, up and down. It cannot just continuously move in one direction. It goes up, reaches a certain level, it starts coming down. So if the market is going up, so we come up with some, from your analysis, you're able to tell when the price reaches here, it tends to bounce back. So that is called resistance. So if the market is going up, it reaches like a resistance, a level it cannot penetrate, it starts coming back. It's like a ceiling. Yeah, like you're on the ground floor, you start climbing the wall, you reach the ceiling, you cannot go further, you come down. But if you go with a lot of force, you can break the resistance and go to the next level, or rather to the next floor. So that when it is going up and it faces some resistance, we call it resistance. If it has been going down, then get to a level it cannot continue going further down, we call it support. And this, we use this a lot when you're doing our analysis, and you're going to see further how do we use them to our advantage. Because it's good to know why is the market like to face resistance, then you buy at resistance, you buy at support, right? Because you know the market is going to rise, it's going to find support and be unable to go down, you buy, then you move up with it. Then we have what we call gapping. What happens? I will not read through. At one time, you can just read through. Just want to explain what gaps are all about. Like today, when we close, by end of day today, the market closes at the New York closing time. Currently, we have the New York market still open. It's going to close the next 2 hours also. So the closing price for Forex, it is the price at which the New York market closed at. Remember, we say the market runs 24 hours. We're going to see that maybe starting tomorrow. Forex market runs 24 hours continuously. But remember, we say there is no particular market because this is the Forex market. This is where it is situated. There are various markets which make the 24 hours, right? One starts, it runs before it closes, another market closes. We have the New York session, London session, and then the Tokyo. Then we have a small market called the Sydney market and Frankfurt. So like they hand over to each other, right? London closed like an hour or so ago, but before it closed, already New York was already in session, like they hand over. So we have the market running continuously 24 hours. So one will ask, so if the market runs 24 hours, how do we talk about the closing price? How is it, do we arrive at that? So the price at which the New York market closes at tonight, that will be our closing price for today. Then Sydney will open. Sydney is a very small market. They open around 1 a.m. or, yeah, around 1 a.m. Let's talk of 2 a.m. Kenyan time. So the time Sydney market opens, that is the opening price for tomorrow, 24th, right? So what happens? Always, the closing price for today should be automatically the opening price for tomorrow. But sometimes, because of one reason or the other, the market forms a gap, right? It closes today at this, but it opens at a different price, either higher or lower, starting tomorrow. So that difference in the previous day closing price and the following day opening price, that is what we call the gaps, right? So the market can form those gaps, and it happens mostly on weekends or when you have some breaking news in some of those major currency countries, right? Like if you have some breaking news in US or London, all those kind of Europe, any of the countries in Europe, then they can cause gapping, right? And you're going to see how do you determine a gap, how do you trade a gap, or how do you stay away from gap? Yeah. So gapping occurs when the market opens either lower or higher than the previous closing price. Otherwise, the previous day closing price should be automatically the following day's opening price. That should always be the case. But one scenario, you have gapping where the opening price is either higher or lower than the previous day's closing price. So that's how gaps are formed. So at your own time, you just read through to see the various types of gaps and what it means when a gap is filled or not filled. But again, in our analysis, we're going to see all this and see how you can trade gaps. Great. We're actually coming to the close, and before we close, just to look at the major currencies and their nicknames. We see there are major 8 currencies which are mostly traded. Of course, when you go to the platform, you're going to see so many other currencies. Here we don't have ZAR. You're going to see the ZAR. You're going to see so many of them there. But you focus on the 8 major currencies which are mostly traded. And when you focus on these, at least you know they move a lot. So you don't have to hold your trade for weeks for you to be in profit. If you focus on the major currencies, you can actually open a trade. After 1 hour, it's in profit. You either close or you lock in your profit and let the trade continue running. So you focus on the 8 major currencies and the data from the 8 major currencies. These currencies also have some nicknames. And you'll ask maybe, why do you need to know the nicknames? Because sometimes as you read some of those analyses, they may not call the currency by its name. They actually mostly use the nicknames in the analysis. So you need to know when they talk about fiber, what are they referring to? When they say the bark or the cable, what are they referring to? So just list some of the nicknames here, just for your use during when you read some analysis, yeah, to understand which currency are they talking about. Like the USD, they call it the greenback, or in short, the back. GBP, they call it the cable. Euro, fiber. Canadian dollar, loonie. New Zealand dollar, kiwi. CHF, Swiss, AUD, Aussie, and Japanese yen, the yen. So, well, not for much really, but you might read some analysis and you see them quoting them by their nicknames. Just good to know what are they referring to. Yeah. So basically that's it about the definition of the terms, because as we go deeper, we'll use some of these terms just in our analysis, in our training. You need to know what are we referring to. All right. So any question? Hope you guys are following. You're very quiet. Any question? Very quiet class today. You see, you're typing, so I'm waiting to see. Great. Let me first answer Lydia's question. Lydia's question is, you talked about locking your profit, then wait for the trade to continue. How do you lock? What happens? Remember we said when you're making a decision to buy or to sell, at that moment, before you sell or you buy, you also determine where you're going to place your stop loss and where you're going to place your take profit. So once you've entered let's say you have bought the pair, USD CAD, and current is at 1.2000, then you buy and you placed your let me just illustrate for you with a board. You can see the board of mine. So it's again, our pay is USD CAD. So the market is, so the price is here at 1.2000. So you do your analysis, and from your analysis, the market is going up. All right, from your analysis. So you buy. Let's say you do a market execution, you click on buy. All right. The moment you buy, already you've set your stop loss here. All right, your stop loss. You're saying, although from my analysis, this market is moving up. In case it is reversed, that's going down, I don't want to go fast. This is the maximum loss I'm willing to take, okay? This is the maximum loss I'm willing to take, all right? That's your stop loss. Then you've done your analysis and you say, the market like to reverse around here. This is my take profit, okay? My take profit, I call it a TP. And your TP is at price 1.200. All right, that is 200 pips. Your stop loss is at 1.1980. A loss of 20 pips. That's what you're willing to take. Sorry. It's 1980. Zero cannot fit in there. So the market starts moving up. You buy, then it starts moving in your favor. All right. Then it reaches somewhere here. And this price, let's say somewhere like 1.2100. The market is still moving up. So at this level, remember we said there is nothing guaranteed. This market can actually reverse without hitting your take profit. So the moment the market moves in your profit and you see it struggling, you move your stop loss to somewhere here. Okay? You bring your stop loss here. This is your stop loss. You've now moved it from 1.1980 to 1.2080. All right? That is 1.2080. So remember you bought at 1.2000, then it starts moving in your favor. You're already in profit. It reaches 1.2100. So you're saying, in case this market just reverses, I cannot just give back a whole 100 pips, all right? So you move your stop loss to 1.2080. So there you've locked in 80 pips. You've locked in 80 pips of profit, all right? Then you let it run. So there now your trade is risk-free. So risk-free. Your trade is risk-free. We are saying in case it starts moving against you, at least you are close at profit, or you're not at a loss. So that's what it means by locking profit. You lock those 80 pips in profit, then you let it run. If it runs and hits your take profit, well and good. You get a profit of 200 pips. If it reverses around this moment, well and good. You don't close at a loss, at least you get 80 pips of profit. So you've already locked in 80 pips in case it moves against you. Hopefully there you got. That's what it means by locking your profit. Then you let it continue, let it run. At least your profit is locked. So it's Caro actually who asked? Sorry, I think I'm confused because this is not the name came in. That was Caro. So that's what it means by locking in profit. Hope you got it, Caro. Great. I'm happy you understood. Then we have Lydia's question. You talked about volatility. From your experience, which is most volatile currency combination? Actually, it depends on many things. First, it depends on the session, which market is open, all right? So the most volatile session is when the London market and the New York market, when how do I call it? When they're both in session. There's a term I'm looking for, sorry. When they overlap, yes. The most volatile moment is when the London market and the New York market, when they overlap. That is when they are both of them open at the same time. That happens between around 2 p.m. South African time. So I know the day you're in South Africa, so I'll use the South African times, but we'll see it in details from tomorrow. So it is between 2 p.m. South African time. Now, that moment you find the two markets are open until around 7 p.m. South African time. For Kenya, just had 1 hour to know which timings are those. So when those two major markets overlap, the best currency to pay may be the USD GBP or USD JPY or even GBP JPY. So volatility depends on the time of the day and the pairs you're picking. But as you continue, you realize that keeps on changing a lot. But the most volatile moment of the market is when the two markets overlap. That is the New York session and the London session. That's between 2 p.m. and that is 2 p.m. South African time to around 7 p.m. South African time. So as you do your demo trading, you'll be able to also pick all these. As you try to demo trade, you see when the currency move most, when do they slow down. But of course, even between that time when there is a US lunch time, the market just tends to be like a little bit dead. So although that moment when they overlap, it's so active, but when you see like the timing for lunchtime for US, the markets will try to die it down. I think they really take their lunchtime very seriously. I don't know, but tends to just die a bit. But from 2 p.m., the market will be very active to around 4 p.m., 5 p.m. around there. Actually very volatile. So the best currency that time is maybe USD and GBP or any of their pairs. USD JPY, GBP USD, Euro USD or USD JPY. But with the time, all this will come automatically. Also depending on the news being released around that, because again, most of the US news are released between around 2:30 p.m. to 3 p.m. South African time. So it also depends on what news are being released. And you're going to see how you can tell which news are being released when and the impact they are likely to have in the market. Any other question? Yes. You can ask. You can ask another question. Okay. The sell limit and the buy limit, do they have a value date or they should be within the trading day date? They don't have. They can run for as long as you want them to stay there. They don't have expiry date. They can just be there until the day they'll be hit. So they don't have an expiry date. You can even leave them for a week, they'll be triggered whichever time the price will hit there. If the price never reaches there, they still just remain there, waiting for the market to behave. Great. Thank you so much for your time. We'll see you tomorrow, but you can ask questions anytime on the WhatsApp, on the group. We can be able to tackle anything you need to clarify. We can always continue discussing. So we can meet in tomorrow's class. Thank you for your time and have a good night. Goodbye.